Welcome to this session. My name is Barbara Gochalia. Today we shall be looking at insurance, and this is the chapter overview. We shall be looking at the objectives of this particular chapter. We shall also be looking at the nature or characteristics of insurance. We shall look at the functions of insurance. We shall also look at prerequisites for success insurance, limitation of insurance, and the scope or classification of insurance, as well as principles of insurance. At the end of this particular topic, we should be able to define insurance and explain its features and functions. We should also be able to discuss the classification of insurance, and we should also be able to describe the principles of insurance. So a number of definitions have been made for insurance by a number of scholars, but the take-home message for us should be that in simplicity, insurance is a social device that is used to reduce or eliminate risks of loss to life, property, and other materials, right? So insurance practically is a social device that helps to reduce or eliminate risks of loss. It could be economic loss, it could be loss in terms of life, in terms of property, right? And then also it is important for us to know the difference between risk and uncertainty. The difference between risk and uncertainty is that risk is measurable, while uncertainty is not measurable. Risk, in terms of the business perspective, is knowing that the outcome of an investment can either differ from the expected, from what is expected, or it can be either, it can come out rightly or not rightly. So with the risk, it is measurable. It can be calculated, right? And the outcome can either be positive or negative. But with uncertainty, you practically don't know what the outcome of the event in the future will be, right? So uncertainty could be, for example, maybe in future, maybe if floods do happen. So you practically don't know what the future holds, right? So that is the distinct difference between the risk and uncertainty. So let us look at the nature or the characteristics of insurance. Number one is that insurance involves sharing of risks, all right? And sharing of risks in this perspective, we mean that various clients will entrust, for example, their property and life with the insurance company. So it's a number of clients that are actually entrusting their property, their life, to be insured by that insurance company. So there is sharing of risk, like we shall see when we come to the principles of insurance, right? So this risk is shared between the insurer and the insured. Then insurance also is a cooperative device, right? Where we are going to realize that it involves, one of the principles of insurance is that it believes in large number. It believes in large number of people taking insurance, because with large number, there the risk will be shared, number one, between the insurer and the person, the insured, the person taking the insurance. And also the insurance companies make more profit. In other words, they eliminate, they reduce the chance of making losses when they have more clients, when they have large number of clients that are entrusting them with their property and the material. Then if insurance involves evaluation of risk. So when when the client, for example, goes right to make a contract with this insurance company, they will there will be what you call an underwriter who will first of all evaluate the risk. This risk will first be evaluated. It will first be calculated, right? Such that the insurance company gets to know how much, for example, ought to be paid in just in case a particular risk does happen to the subject matter of insurance. So practically, this there is evaluation of the risk, right? Even before the contract is made with the person that wants to take insurance. Then insurance involves payment, right? Payment, it involves payment on the happening of a specified event. So we are going to realize that in the principles of, among the principles of insurance, right? Depending on what kind of insurance, the payment has to be made to the insured when there is an occurrence of when that risk actually happens. For example, it could be fire, it could be marine, what we call perils of the sea, it could be an accident, right? So depending on what kind of insurance, the subject matter of insurance, then the payment will be made. Of course, there are policies that are followed, there are laws that are followed, and of course, according to the contract that would have been made between the insurance company, the insurer, and the insured. Then in terms of the amount paid to the insured, it will depend on the policy, right? It will depend on the contract, and it would practically depend on the policy that was between the two parties, right, on the insurance policy. Then insurance is also characterized by a large number of insured persons, right? It is characterized by a large number of insured persons. For example, we are going to realize that among the principles of insurance, it does state, it does provide information, or it stipulates that there are certain elements, right, that cannot be, there are certain elements or subject matter that cannot be insured, right? So insurance practically believes in the law of, it believes in large numbers, whereby we are going to realize that there are certain things that cannot be insured, especially when they do not, they do not make the large numbers, because it is with the large numbers that these insurance companies or insurers will be able to minimize the loss, of course, on their side. Then another characteristic or nature of insurance is that insurance is not a gambling. It's not gambling as people think. Probably some of us have, most of us, we have a negative, we've had a negative attitude, or even it could be because of lack of knowledge, right, or information about insurance. But most people think that it is gambling, but practically insurance is not gambling. Why? Because gambling is illegal, right? Gambling is illegal, right? And it may lead one party to lose, right? Where one party loses to another. Whereas insurance is insurance is legal in a way that it involves making a contract between the two parties, between the insurer and the person being insured, right? And the person taking the insurance. So the mere fact that it involves entering into a contract before the two parties, it means that it is not gambling, as some of the people may think. Then also insurance is not charity, right? It's not charity. Why? Because charity involves payment without consideration of it involves charities like it's actually just helping without requiring repayment, right? For example, it can be charity to help the poor, to help the needy, to help the orphans. It is just a charity is just helping without expectation of payment from the person that you are helping, right? It could be in terms of financial or in terms of cash or non-cash terms, right? But with insurance, we are going to realize that it involves a contract, and of course, the payment will depend on whether the insured would have paid a premium, of course, up to a certain amount, depending on the insurance policy. Then insurance also aims at protection against risks, like we've already seen in the definition for insurance, that insurance is a social device that reduces or eliminates risks, right? But it may be risk against life, against property, and the other elements in the subject matter of insurance. Then also another characteristic of insurance is that it involves spreading of risks, right? It involves a spreading of risks. Like we've already seen that insurance, that very many people will entrust their elements under the subject matter of insurance to the insurance company. So it's a large number of people that will entrust this insurance company, for example, to provide insurance for them. So that's why we look at this characteristic of spreading of risks, right? In that perspective. All right. So practically, these the insured are transferring their risks to the insurer, in brief, right? Then it also involves transfer of risks. Like we've already seen that the insured are transferring this risk to the insurance company, all right? Such that in the case of losses, we are going to realize that there is a sharing of risks, right? In that regard. All right. Then also it involves insurance involves ascertaining of losses. Of course, at the time when a risk occurs, at the time when that unexpected event, right, occurs, then it means it could be maybe an accident. It could be the perils of the sea, marine insurance, fire, right? Where the fires occurred, burglary, what you call burglary or theft or robbery, right? So what happens is that we are going to realize later on under the principles of insurance that, for example, when a fire has occurred, right? When a fire has occurred, especially to the property of the insured, the person that took the insurance, it is the right, or it is upon the insurance company to come and verify and verify and get proof of what caused the fire, and the proof must be known. Yeah, the proof must be known in order for this insured, for the insured person to be compensated, right? Or to be paid what you call an indemnity. Then the insurance is also characterized by a contract, right? Like a contract, right? So it involves a contract between the two parties, between the insurer and the insured, right? Like we've already seen that insurance is not gambling, right? Because gambling is legal, but insurance involves these two parties entering into a contract. Then insurance is based upon certain principles. We shall later on see, we shall later on look at the principles of insurance, the principles that govern insurance. So there are basically 6 principles, fundamental principles that govern insurance. So insurance in itself, it is governed, it is based upon certain principles. We shall be later on looking at them in detail. But of course, some of them include utmost good faith, insurance interest, contribution indemnity, and what we call causa proxima, right? So it is based on those principles. It is also based on the principle of subrogation. We shall be looking at these in detail. Insurance also is institutional setup, right? Insurance is institutional setup in a way that these insurance companies are governed, they are governed by institutions. For example, here in Uganda, the insurance companies are governed by the insurance regulatory authority. So these insurance companies, or these insurers, these insurance companies are institutional setup in a way that they are governed by government bodies, regulatory bodies. For example, here we have the Insurance Regulatory Authority that governs these insurance companies. So the insurance is only taken, is only made for pure risks only, right? And of course, and the pure risks give only losses to the insured and no profits, right? So the insurance is provided, is granted, or it's provided to what we call pure risks. And what are the examples of pure risks? Pure risks include accidents, misfortune. Now someone may be asking, what is a misfortune? For example, it could be floods, right? Those what we've looked at as uncertainty, probably floods, right? Probably mudslides, those are misfortunes, right? Then death, it could be fire, it could be injury, right? Burglary, theft, or robbery, those are pure risks, right? But this insurance, it is important for us to know that it is not provided, or it is not granted to a special, what we call special risks, right? And what are special risks? Special risks comprise, among others, business ventures, right? Business ventures, gambling transactions. So gambling, you cannot insure these gambling what? Transactions. For example, the so-called sports betting, you cannot insure those ones. You cannot insure a business venture, right? Why? Because we've seen that a business venture will involve business ventures are measurable, right? They are measurable, but again, it is something that you cannot tell, right? You're uncertain of the outcome. that one you cannot insure, right? Because we've seen that insurance involves evaluation of risks, whereby before you even sign the contract with the insurance company, these risks have to be evaluated. They have to know the approximated amount of risks, right, that they will be able to pay in case that event occurs. It could be fire, it could be what we call perils of the sea, marine perils of the sea are basically what happens on the sea, right? For example, it could be that you are shipping products via the sea, right? Most of these via the coast, right? Most of these exports are shipped, yeah, via the what you call the seaports, right? So there is that risk of, for example, having sea pirates, those thieves on the sea, you know, floods, right? These ships capsizing. So all that risk is what we call the marine, the perils of the sea, and these involve taking marine insurance, right? Or insurance of the sea, of the waters. Marine means water. So practically that is that. Then insurance is a social device, like we've already seen in the definition, that insurance is a social device that eliminates risks, and uncertainty, that eliminates risks, that could be on property, life, and other elements, under the subject matter of insurance. Then insurance is based on mutual good faith. Actually, that is the principle of what we call utmost good faith. Which involves the party. It involves both parties. It involves these parties to disclose. It involves the insured, the person taking the insurance, to disclose important facts that are affecting the contract, important facts in the subject matter of insurance, right? That's what we call the principle of good faith, or utmost good faith, right? It's one of the principles of insurance. So these parties should be able to disclose all the important facts affecting the subject matter of the insurance. They are supposed to disclose them in this contract between themselves, right? For example, if you are disclosing information, if you want to insure your life, right? We are going to see, for example, life insurance. You should be able to disclose all the information about your life, about, right, whatever that is happening in your life. Otherwise, if you do not disclose and this insurance company gets to know, then that contract will be declared null and void, right? Then insurance do operate under regulation, or law. So practically there are laws governing insurance. And these insurance businesses, right? Like we've already seen that they are governed by these their institutional setup, so they operate under the law, right? Then insurance is a wide scope. It is a wide scope phenomena, right? So it involves a wider scope in a way that it involves various types of policies developed against these risks, these various types of risks under the subject matter of insurance. This could be risks of life, risks that involve fire, right? Marine, which you call perils of the sea, accidents, theft or burglary, right? Or robbery, all those ones are involved in insurance. And we are going to find out, to discover that there are very many other subject matter of insurance, very many other subject matter that can be insured, right? All right, let's look at the functions of insurance. So these are categorized into primary functions, secondary functions, and other functions. So let us look at the primary functions of insurance, and these include providing protection. So insurance aims at providing protection, and of course protection depending on the subject matter of insurance. For example, we are going to realize that it could be insured, even loans can be insured, right? Life can be insured, crops, even crops in agriculture can be insured, animals, for example, if you have cattle, you can insure those ones. So a lot of things can be insured, right? But the whole objective of this would be aimed at protection, right? Then a collective, remember these are primary functions of insurance. Collective bearing of risks. Actually, if you realize that most of these primary functions of insurance are actually they are actually, most of them are actually characteristics that you've looked at as characteristics or nature of insurance. Then also another primary function of insurance is collective bearing of risks. Like we've already seen under the characteristics or nature of insurance, that it involves what we call large numbers, right? Whereby we see a number of people that are interesting, their property, their lives to be insured by this insurance company. And at the end of the day, even according to the principles of insurance, it believes in large numbers, right? That's when it will be able to eliminate its losses. All right. Then another primary function of insurance is evaluation of risk. We've already seen this in the characteristics of insurance, and that's why it is very important to note that actually these primary functions of insurance are actually the characteristics of insurance, if you've been able to notice that. So evaluation of risk is another primary function of insurance, where we've already seen in its characteristics or nature of insurance that these risks have to be evaluated by these underwriters, right? Before even a contract is made. In other words, they have to evaluate and find out how much of the risk can be involved in that particular subject matter under insurance, right? And how much can be paid as indemnity to the insured in case that event occurs. It could be maybe fire, it could be burglary, theft, right? It could be the floods, the marine perils, depending on the subject matter under insurance. Then another primary function is to provide certainty against risk, right? So of course, with insurance here, we've seen that when someone insures, for example, let me say their business, their lives, right, and a lot of other things, their vehicles, their crops, their cattle, they are certain about the future, right? They'll not be worried, because they know that in the case any uncertain event occurs, then the insurance companies, these insurers, will be able to compensate them what you call indemnity, to pay them an indemnity. Then spreading of risks, we've already seen this in the characteristics or nature of insurance, that it involves a spreading, distributing of risks. So practically, these people, the insured, right, are distributing their risks with the insurers, right? And we are going to see that under the principle of contribution, that it requires that the insurer and the insured share the contribution, they share the risk, they share the losses, right? Then let's look at those who are primary functions. Let's look at the secondary functions of insurance. Number one is prevention of losses. So we know that when these, we already know now that when these events occur, right? For example, fire, perils of the sea, you know, even death, where we see that with life insurance, when, for example, someone dies, what will happen is that they will compensate, they will compensate depending on the policy and what the person agreed, the insured. They will compensate, for example, his or her family, right? They will compensate them, right? That's if it's life insurance, right? It could be what you call third party liability, right? So all those ones are types of insurance. So at the end of the day, the essence of this would be to prevent losses, and this is a primary function of insurance. The second primary function of insurance is that small capital is used to cover large risks. So there is a premium that these insured pay, are required to pay by the insurers or the insurance companies. And but at the end of the day, you know, when you insure, the fact that the losses will be minimized, either eliminated or reduced, at the end of the day, it will turn out that you've used less capital to actually cover these risks than when you've not insured maybe that business at all, right? So at the end of the day, it might be less costly for you to insure than to totally not insure the subject matter and insurance. Then another primary function is that it contributes towards the development of larger enterprises. It contributes towards the development of larger enterprises. So in this way, for example, if we have businesses that are taking insurance, right? If businesses are insuring themselves, then it means that these businesses can be even credit worthy to get loans, right? Because banks would want to give, they would want to give loans to businesses that have been insured, because they know that even if these, in terms of maybe we looked at financial crisis in our previous class. And we saw that even these financial institutions, the so-called, you know, banks and financial institutions that that had lived for long, yeah, during that global financial crisis, they actually collapsed. They became bankrupt. Remember, we looked at the Lehman Brothers, right? The Lehman Brothers, that financial institution in the US that actually began in the 1800s, right? It collapsed in 2008. So if at all these financial institutions, for example, I mean, if at all these financial institutions maybe had insured themselves, maybe they wouldn't have become bankrupt. So businesses that have insured themselves are considered, they are deemed creditworthy by financial institutions, by banks. So they can get loans. Are we together? They can get loans. So in getting these loans, of course, at the end of the day, it is boosting businesses, it is it is increasing economic activity, and it's contributing towards the development of these larger enterprises or businesses. All right, so those were the secondary functions of insurance. Let's look at other functions of insurance. Let's look at other functions of insurance. And number one is that it can be a means of savings and investment. It can be, it is actually one way of saving and investing, all right? So like you take your money to the bank, even with insurance, it is the same, it could be similar. So it is one way where we realize that here maybe in Uganda, it may not be really very applicable, but in other countries, especially developed countries, these companies or businesses that do insure, right? Or even people that do take insurance, they can be exempted from paying income tax. Are we together? So they can be exempted by the government from paying income tax because they are contributing, they are insuring by these insurance companies. And of course, these insurance companies contribute towards the tax revenue, towards government revenue through their taxes. So these people that are taking the insurance, they will be exempted. They will be exempted from income tax exemptions. Yeah, it is there, but of course, I don't think it is it is happening the same way it does happen in the developed world. Then insurance also can be a source of earning foreign exchange. It can be a source of earning foreign exchange. How? For example, we've seen marine insurance, right? With the marine insurance, we are talking about the waters. We are talking about the sea, right? The sea, for example, shipping, yeah? Exporting could be, of course, the transportation of these exports could be in different modes of transport. For example, it could be the water transport where we are shipping practically. Maybe these exports are passing via the sea coast, right? Like, for example, here in Uganda, of course, us being a landlocked country, most of these exports pass through Kenya, right? They pass through Kenya because it is where the sea coast is. So it means that here these exports can be insured, and that's what we call marine insurance. So if these exports are insured, then the country is certain, the country or the government is certainly sure that we shall not have losses, right? So practically that one boosts international trade because businessmen and businesswomen, companies will be able to do the international trade without any fears, right? Or without any uncertainty. So it promotes international trade, which in turn will be a source of foreign exchange to economies. Then it promotes, of course, exports, and this one is interlinked with foreign exchange. And of course, promoting exports also in the long run provides employment, right? Because these firms that are exporting, they are also employing the country citizens, right? So it is also promoting exports. Number one, improves the country's balance of payment, where it is improving the exports. Where, for example, if the exports are more than the imports, of course, that one gives a good balance of payment position. for the country. And then also these companies that are exporting are also employing citizens, country citizens, which of course at the end of the day generates government revenue through the taxes, of course, that these employees are contributing and the companies themselves. Then insurance also provides social security, right? So for example, here, when we talk about social security, the very first thing that will come in our minds is what? National Social Security Fund, isn't it? But even insurance is a social security. How? In a way that when these insureds, the people that take the insurance, at the end of the day, are depending on the subject matter of insurance that they've entered into contract with the insurance company, they'll be able to be paid that indemnity, right? Of course, if it's life insurance at the time of death, your relatives can be paid that indemnity. It could be maybe insurance. You're going to see that there is the health insurance, and we shall be health insurance, for example, and we shall be looking at the difference between health insurance and life insurance, right? Then could be insurance in terms of old age, where people insure, like the way NSSF does it, that people are insuring, the whole essence is people, retirement, preparation for retirement. That's what NSSF is all about, yeah. But here with the insurance, of course, a number of subject matter under insurance are considered. It could be health insurance, insuring for old age, right? Maternity, right? So all those ones are involved. And at the end of the day, this is social security for the person that is taking their insurance. So let's look at the prerequisites for the success of insurance. Prerequisite is like what is required. What is a prerequisite is like a must. What should actually be like priority? What should actually in this perspective, if we say prerequisite, is that what should really happen for insurance to be successful, right? Or to have positive outcomes. So number one is that there should be presence of large number of risks, right? Whether at individual level or group level. That, for example, at individual level, you must have, for example, if it is life insurance, you must expect like a numerable number, right? A substantial amount of risks that maybe could happen in your life, right? For example, it could be that if you're taking, for example, there is that kind of risk, for example, where we look at crop insurance in agriculture. For example, they will first evaluate that kind of risk. And if they see that the kind of risk that is bound to happen is less than what is expected, they will not actually accept, they will not allow you to insure that after evaluation. So that's why even in the principles of insurance, they believe in large numbers. Why? Because if they have, for example, if they have very many clients, they will be able to minimize losses. These insurance companies will be able to minimize losses, and that's how they work. That's the logic behind these insurance companies. Then number two is that there should be more risks in the life or the property of a person so that they feel necessary to be insured. Like we've already looked at this, yeah, that even the property that you want to insure, that it should be like, it should have a number of risks, substantial number of risks. They'll look at it at this property and they're like, no, this property is not bound to, substantial amount of risks, and therefore you should not take insurance for it. So they will first assess, like we've already looked at in the characteristics and nature of insurance, that it involves evaluation of risks. Number 3 is that probability of real loss, the probability of real loss on account of risk, right? So the meaning of this statement or this phrase is that in a case, just in a case that event occurs, that loss occurs, the probability of loss, in other words, after these people, these insurers they first evaluate, right? They actually use that law of probability and they evaluate. If they see that the probability that a loss will, the probability that that risk will happen is low, they will not actually accept. They may not allow you to take insurance for that particular subject matter that you want to insure, right? Then the presence of large number of people exposed with the same nature and kind of risks, right? So they believe in large numbers. They believe in large numbers, that they believe in having very many clients, right? Such that because the logic of that is that at the end of the day, for them, they are reducing losses. Because of course, when you have more clients, you as an insurance company, the probability of losses occurring will be minimized. If one person gets the loss, you repay, but at the end of the day, these other many clients, these other clients among the many will actually be able, the kind of premium they are paying to you will be able to even offset the indemnity that you have paid to these people, to these few people or few clients that would have experienced the losses. Then the involvement of loss from the risk must be large enough, right? Involvement of loss from the risk must be large enough. If what happens here is that if that loss does occur to the insured, then and they evaluate and they find out that that loss is minimal, they will not pay you an indemnity. They will not. So that's how these insurance companies work, right? And then next is that the loss from the expected risk should be determinable in advance. The loss from the expected risk should be determinable in advance, right? So that's why in our very first key concepts, we were able to look at the difference between risk and uncertainty. We were able to look at the difference between risk and uncertainty. And what did we see? We realized that risk is measurable, and that the outcome of the event can be determined, right? It can either be a loss or a profit, right? Positive or negative. But with the uncertainty, you do not know what the outcome might be. So at the end of the day, we saw that under the characteristics or the nature of insurance, we saw that insurance can only be taken for pure risks and not speculative risks. So actually, that is the meaning, that is the literal meaning of that statement. It literally meaning that that at the end of the day, insurance is only granted or given to pure risks and not speculative risks. Then the happening of loss or the event must be beyond the control of the insured, right? So what this means is that, for example, if a fire occurs, yeah, let me say if, for example, an accident occurred, these people will first come and these insurers, they'll come and find out the cause of that accident, maybe a vehicle accident, right? If you, the insured, you are driving while you are drunk, then who should be liable? Of course, when you are driving when you are drunk, you are driving when you didn't have a driving permit. They will look at those scenarios. So these people will have all reasons. They will look for all reasons of not paying you. So that's why even a number of people have negative impressions about insurance. But the most important thing is that when you've studied this and you have knowledge, because it has a number of policies actually that which when you have learned and grasped, you can actually reason them out, right? So what this statement means that the happening of the loss or event must be beyond the control of the insured, right? So we are going to realize that the insured should put all measures to guard against this risk. Are we together? To guard against this risk. If it is accident insurance, again, insurance against accident, maybe vehicle accident, then you have to make sure that you are on the right track. You were on the right track by the time this road accident did occur. You are not drunk, you had your driving permit and that all those things, because they'll look at those ones too before they pay you the indemnity. Are we together? So that is the meaning of that that particular phrase. Then next is that the loss to all the insureds should not take place at the same time. So you can see all these prerequisites. They are actually so binding. That me, I call them indirectly. I call them strings. Strings attached, right? So there are too many. And you cannot be, it is a little difficult to, it's a little difficult to follow all these and be 100%, correct or perfect. So then next is that the loss of all the insureds should not, the insureds are the people taking the insurance, yeah, should not take place at the same time. So you just imagine if these people, for example, had taken insurance against fire, and it so happens that at the same time, all of them are experiencing that event. Their property has been burnt with fire. So this insurance company don't accept that, because if that does happen, then it means that they are going to have a lot of losses in terms of paying these people their indemnity, right? So for them, that's what they believe. For them, for their business to be successful, that's what the condition should be. Even when they are paying, they don't pay at the same time. Because it is believed the condition is that for them to be successful, for their work to be successful, these losses should not occur to all these insureds at the same time, right? Otherwise, the problem in discharging all the claims at this time will be making losses to this particular insurer. Then next, the cost of insurance should be feasible. When you talk about the cost of insurance, so with these insureds, they pay what we call premium. They pay a premium. This could be either, depending on the insurance policy, it could be annually, it could be monthly, right? So they pay that premium to the insurance companies. But that premium for this insurance business to be successful, that premium should be, I should say, it should be affordable, right? Should be feasible. It should not be too costly. I should not be costly for these people taking the insurance. That's what it means. Then the risk insurable should be such to become easier to calculate the actual loss, right? Whereby we are going to realize that if this loss cannot be measurable, then the insurance company is not going to repay, or is not even going to accept this person that wants you to insure the subject matter, right? Because we have seen that insurance involves evaluation of risk. So they will use their underwriters to evaluate that risk even before you enter into a contract with them, right? Then let's look at the limitations of insurance. Number one is that all the risk cannot be measured, right? All the risk cannot be measured. So like we've already seen that insurance involves evaluation of risks, right? And we saw that insurance can only be done for pure risks like fire, the perils of the sea, right? Burglary or theft, right? It can be done for such accidents, but it cannot be done for speculative risk. Remember, we saw that an example of speculative risk was gambling, business ventures. So not all items under the subject matter of insurance can, only those that are measurable can be insured. So that is the limitation. Number two, the second limitation is the insurable interest. The insurable interest. We shall be looking at the meaning of the insurable interest when we come to the principles of insurance, when we come to the principles of insurance. But briefly, insurable interest means it means, I wouldn't want to use the same word. The person taking the insurance, yeah, should have insurable interest. Maybe I should give it in terms of an example, right? This person should have insurable interest at the time when the contract is being signed, at the date when the contract is being signed. And we are going to see examples of insurable interest. For example, a parent can have insurable interest to have maybe the life of her child to be insured. Are we getting? A father can have insurable interest for his son to get life insurance. And also the son can have insurable interest for the father, for his father or mother to get insurance. A sister can have insurable interest for his brother, for her brother to get insurance. And the brother can have insurable interest for the sister to get insurance. Then an employer also can have insurable interest for the employee to get insurance. In other words, the employer can provide the insurance to the employee, right? And even the employee can have insurable interest for the employer to get insurance. So that's the meaning of insurable interest. And we shall be realizing that for some scenarios, like if people are just lovers, yeah, just someone, what you call, is it love, what, or passion, someone is just a girlfriend or you separated and that kind of thing, there you don't have insurable interest. This is according to the principles of insurance. So that is a limitation that we are going to realize, that there are certain situations where you cannot take insurance, especially when the person does not have insurable interest. Are we together? And then another limitation is impossibility of measurement of real loss. Possibility of measuring the real loss, right? So in a case, it could happen that an event has occurred, but at the end of the day, this event cannot be measured in terms of monetary. The losses, you could find that the losses cannot be measured in terms of money, right? Maybe there could be huge losses, that kind of scenario whereby maybe they cannot even ascertain the cause, right, of that kind of event, and it becomes difficult or challenging to measure that, to measure the loss. So that one will be a limitation. Not all losses can be measurable. Then it is not possible to ensure risk covered by a single individual or a small group. Like we already saw that insurance involves large numbers. Large numbers, it believes in operating with large numbers of clients. So if for example, we are having only one person, you're insuring an item under the subject matter of insurance, but it's not even there, it's not having substantial amount of risk like we've already seen, then you will not be required to, you will not be required to insure it according to the insurance, the insurance policies. Then these insurance companies, most of them or some of them have higher premium rates, and we've seen that for this for the insurance to be successful, these premium rates should be feasible, right? The premium rates should be feasible, they should be affordable. So if it is costly, that is a limitation, right? And then what we call moral hazard. Anyone that remembers moral hazard? I don't think there is anyone here who remembers moral hazard. But in moral hazard, we looked at it, probably some of you have not attended the microeconomics class, but we looked at it, or moral hazard simply means lack of info. It could happen because of lack of information on either either party, or on one of the parties, either the insurer or the insured. So what happens with moral hazard here is, for example, when, for example, this insured person realizes that they may not be paid, that indemnity, those claims will not be paid by the insurance company. Yeah, in case that event occurs, maybe an accident, right? Maybe fire, maybe theft or robbery. They may try to fake a scenario. Are we together? They may try to fake a scenario. Maybe they fake an accident, maybe they destroy some kind of their property such that they can get paid. They can be paid that indemnity by the insurance company, right? So that kind of scenario is what we call moral hazard, where someone will fake a scenario because they feel the insurance company has not paid, and they feel they are entitled to being paid by this insurance company. So that's what we call what? Moral hazard, right? Whereby these insureds, these people, they misutilize the insurance plans for their self-interest by claiming false claims from the insurance company. So they may fake scenarios whereby they want these insurance companies to pay them. So that's also a limitation of insurance. All right. So even when then certain private insurers are not permitted to insure some specified types of risks, like unemployment insurance, right? Or bankruptcy of banks. So such kinds of insurance are not allowed, may not be allowed to be undertaken by the private insurers, where we are going to realize that some of these ones, like unemployment insurance, they involve a cooperation between the government, because especially when these workers are government workers, even when they are private workers, government has most of the information about these employees, right? So these insurance companies, given the fact that they are private entities, they are private businesses, they have to work hand in hand with the government. Then another limitation is that insurance is an attractive investment. It's not attractive, right? It's not, and it's not a profitable investment, right? For example, here in our country, I don't think people have really, many people have really bought the idea of insurance. Maybe a few, but most of them, either because of lack of information or a negative perspective about insurance, they've not really, like bought the idea of doing what? Of taking up insurance, right? Even given the fact that these premiums are, they are high for these people to pay. I mean, if you don't have, for an ordinary person, if you don't even have food to eat, why would you, waste money on such things that that probably most of the people look at as a luxury, right? Maybe because they've not been sensitized, or even they are poor, they cannot afford to insure these other, maybe their lives, property, and so on. So insurance is not really an attractive investment, and it's not even profitable, right? Then with insurance, like we've already seen, that for some types of risks, for example, unemployment, taking unemployment insurance, it involves cooperation of the government. So it's not that all types of subject matter under insurance will really be handled by these private insurance companies. For example, insolvency of banks, most of these banks will not really insure, might not insure with these private insurance companies, may not be allowed because, of course, the government has, remember when we looked at the central banks and the central banks practically, where we saw that these central banks govern the commercial banks, right? And they have all the information about these commercial banks. So even in these private insurance companies, in order to provide the insurance for these banks and the other financial institutions, they have to work in cooperation with the government. So they are limited in that way. They are limited. Then another limitation is that all the pure risks are not insured, right? Not all the pure risks are insured. Remember, we looked at the pure risks where we saw, for example, fire, burglary, marine, the perils of the sea, right? Those ones are pure risks. For example, an insurer may not take interest to accept a proposal of a person whose heart surgery has gone through, right? So some of those scenarios that do happen, these insurance companies may not be liable. So that's why even most of the people have a negative impression about these insurance companies. So let's look at the scope or classification of insurance. So insurance can be classified according to the nature of business. It can be classified according to the business point of view. It can also be classified according to the risk point of view. So let's look at classification of insurance according to the nature of business, yeah? So according to the nature of business, insurance can be classified into life insurance, fire insurance, marine insurance, social insurance, and miscellaneous insurance. So let's look at life insurance, right? Life insurance. So with the life insurance here, the insured will enter into a contract with the insurer, with the insurance company, in such a way that any injury that happens to this person, any injury apart from accident, I want us to take note of that. Any injury that happens to the life of this person, apart from accidents, the insurance company will be able to pay an indemnity to this person. For example, at the time of death, this person's relatives can be paid that indemnity, right? So practically that's what happens. But of course, what happens is that this person, that the insured that takes the insured, will have to pay a premium to the insurer. That's premium can be in terms of a lump sum. Lump sum, we mean that it can be paid as a block figure, right? Or periodically. Periodically, it could be maybe annually, maybe monthly, depending on the insurance policy between the two parties. So the life insurance here, the insured is practically taking insurance for the contingent for an uncertain uncertain event that could occur on this person's life. But of course, here it excludes accidents. It excludes accident, right? All right. Then fire insurance, yeah, fire insurance. This is insurance according to the nature of the business. Fire insurance. So fire insurance is an insurer. It is a contract to indemnity. Indemnity is that payment that the insurer or the insurance company makes to the insured when that kind of event occurs. For example, if it is fire insurance, when the fire occurs, then the payment that the insurance company will pay to the insured will be called an indemnity, right? So fire insurance is a contract to indemnity, right? Such that at the time when the fire occurs is when the insurance company will pay that indemnity to the insured, right? Of course, it will be payment for the loss made by the insured according to the stated policy between the two parties. All right. So practically, it will be payment of that indemnity against the loss that has been incurred by the insured. Then we have marine insurance. We have marine insurance. This, of course, is done to the perils of the sea. And what are the perils of the sea? We have, for example, sea pirates. Yeah, you've heard of sea pirates? Those thieves on the sea. They do happen, whereby maybe they may enter that kind of ship on the sea and they rob people, that kind of thing. You've seen those that one in maybe films, yeah? But it does happen even in the real world. Those thieves on the sea, they capture people, right? Those things do happen. So in such scenarios, it could even be a fire, right? So all those navigation, those perils that do happen, accidents that do happen during the navigation of the sea, they actually take what we call that kind of insurance against such perils of the sea is what we call the marine insurance, right? This is what they call the marine insurance, right? So even the marine insurance is a contract of indemnity, whereby at a contract of indemnity means that at the time when that event, for example, when those sea pirates attack those people on the sea, maybe they're in the ship, that kind of scenario, it is when after that event has occurred is when the insurance company or the insurer will pay that indemnity for loss to the to the insured, right? So of course that one will be in terms of business. If your business is operating via the sea, it requires maybe transporting goods via the sea, then you will take that kind of insurance. Then we have social insurance, right? So practically this one will be aimed at providing economic security to weaker sections of the society. And social insurance comprises the following. It could be in form of sick insurance, right? Where people take sick insurance such that at the time when they fall sick, they'll be provided with medical benefits. They will be provided with the treatment. The insurance company will pay these medical bills, right? Then this social insurance could be in terms of death insurance. Did you know that? Death insurance, whereby if someone can take death insurance and they are paying that premium. If they die, the dependents will be paid that indemnity, right? The economic assistance will be provided to the dependents in case this person dies, of course, during employment. Yeah. If it is provided by the employer, if the employer was the one paying that kind of insurance. Because if it is social, of course, here, and we are looking at the employer is doing it for his workers, his employees. Then we have disability insurance. This is under social insurance, right? Disability insurance. Here, for example, if it is the employer maybe providing this insurance to his or her employees, then the person, one of the workers maybe is gets an injury maybe from a machine during work, during their line of in their line of duty, yeah, while at work, then the insurance company will be able to pay this person. The insurance company will be able to pay the indemnity to this worker for this particular company that has been paying insurance for them. Then unemployment insurance, right? So this one also is geared towards providing economic support to the insured at the time when they do not have a job, when they are not, when they maybe they've lost their job, when they are not working, until the time when they get another job. Then old age insurance, this is still under social insurance. Old age insurance, this is under still social insurance. Of course, old age insurance is taken as people plan for their, for example, retirement or old age, right? Practically with an objective of being provided economic assistance by the insurer or the insurance company at the time when they have aged, right? At a certain age, maybe when they can no longer work and so on.